Financial reporting analysis, income taxes. Now, example one, the following information pertains to a hypothetical company, Restaurant Partners. And in the question, it is stated that the tax rate is 30%. The financial performance and accounting profit of partners on this income statement is based on accounting principle appropriate for the jurisdiction in which Restaurant Partners operates. The principle used to calculate accounting profit before tax in the example above may differ from the principle applied for tax purposes, very important, which is used to calculate the taxable income. For illustrative purpose, however, assume that all income and expenses on the income statement are treated identically for tax and accounting purposes, except depreciation. The depreciation is related to equipment owned by Restaurant Partners. For simplicity, assume that the equipment was purchased at the beginning of the year 1. Depreciation should thus be calculated and expensed for the full year. Assume that the accounting standard permit equipment to be depreciated on a straight line basis, a 10-year period, whereas the tax standard in the jurisdiction specify that the equipment should be depreciated on a straight line basis over a 7-year period. For simplicity, assume a salvage value of 0 at the end of the equipment useful life. Both methods will result in a full depreciation of the asset over the respective tax or accounting life. Now, the equipment was originally 20,000. So for accounting purpose, the depreciation would be 20,000 divided by 10, that is 2,000. And for tax purpose, this would be 20,000 divided by 7, that is equivalent to 2,857. Now, as we can see that the depreciation expense for accounting and for tax purpose both will be different, and hence both will going to produce a different taxable income. Now, for over here, the profit before tax is 4,700 for year 1, 15,280 for year 2, and 2,670 for year 3. Now, if you calculate the tax, let's calculate the tax on the basis of 30%. So 47, now this is 1 year, 2 year, and 3 year. So 4,700 into 0.3 would going to give us 1,410. 15,280 into 0.3 will going to give us 4,584, and 26,700 into 0.3 will going to give us 8,010. So these are the taxes that we are paying on this accounting book. Now this is for taxable income. This is your tax book. Because the depreciation we are using is different over here, hence the taxable income that is being produced is also different. So the tax over here would be year 1, it would be 3,843 multiplied by 0.3, that is 1,153. 1,4,423 into 0.3 would be 4,327, and 25,843 into 0.3 would be 7,753. Now this is for your accounting book, and this is for your tax book. Now if you can compare accounting with tax, accounting was 8,010, 4,584, and 1,410. Now the thing you need to understand is that the taxable income is different, and the depreciation expense is higher in taxable income. In your tax purpose, for your tax purpose, the depreciation expense is higher, hence producing a lower taxable income, hence producing lower taxes. But this lower taxes actually generates deferred tax liability. So it produces deferred tax liability, and we can see why. Because for tax purpose, the tax is 1,153, but for accounting, it is 1,410. So technically we paid $257 less taxes. So this is our liability. Again, 4,327 minus 4,584, the difference is 257. This is what we should be paying. We paid 4,327 according to tax books. So it is 257. Accounting is 8,010, and for tax purpose it is 7,753. Again, the difference is 257. So this is our liability. The first year liability is 257. This is your first year liability 257. Second year liability is again 257. So the total liability would be 257 into 2. That is your 514. And for third year again, we we have a liability of 257. So the third year, your total deferred tax liability would be 771. And we can see it from here as well. But we also need to use this formula in order to find out deferred tax liability, that is your carrying amount minus tax base multiplied by tax rate. Your carrying amount is the carrying amount of your assets according to the accounting book, and the tax base is your carrying amount of the asset according to the tax books. Now, for the first year, or for your accounting books, we had the equipment of 20,000, depreciation was 2,000. So year one, year two, year three, the carrying amount at the end of year one would be 18,000. At the end of year two, it would be 16,000. At the end of the year three, it would be 14,000. For tax books, our depreciation is 2857. So the equipment is 20,000 and the depreciation is 2857. So first year it would be 20,000 minus 2857. It would be 17143. For year two, it would be 2857 again, 14286. So we are subtracting 20,000 with 2857, we get 17143, and again we subtract 2857, we get 14286, and again we subtract 2857, we get 11429. Now our deferred tax liability for the first year would be carrying amount, that is 18,000, minus 17143, that is your tax base, into 0.3. This will going to give us 18,000 minus 17143 into 0.3 is 257, as we also calculated before. So the difference over here was of 257. Accounting book is saying that we need to pay tax of 1410. The tax book is saying 1153. So we pay $257 less taxes. So hence our liability is of 257. Year two, this would be 16,000 minus 14286 multiplied by 0.3. 16,000 multiply minus 14286 into 0.3 is 514. Year 3 would be 14,000 minus 11429 into 0.3, that is again 771. And we also need to understand that these are temporary differences. Now we also need to understand that the formula income tax based on financial accounting equals to income tax payable plus change in deferred tax liability. So our income tax payable was 1153. So these are your income tax payable 1153, 4327 and 7753. And if you look, the change in deferred tax liability is of 257. So each time 257 is increasing. Now your income tax payable was 141153 and the change in deferred tax liability was 257. So 1153 plus 257 equals to 1410. This is again a very important formula. This is for your first year. Second year, your income tax payable was 4327 plus again the change in deferred tax liability was 257, that is constant throughout 3 years. So 4327 plus 257 is 4584. And for third year, again your income tax payable was 7753 plus change in deferred tax liability, and we get income tax that we need to pay is 8010. Now this is your consolidated income statement for Reston Partners including income tax is presented below. So these are the income tax that are given, and we have also calculated income tax through this formula. Example 2, determining the tax base of an asset. The following information pertains to Antiguan Sports are hypothetical developers of products used to treat sports-related injuries. The treatment of items for accounting and tax purposes is based on hypothetical accounting and tax standards and is not specific to a particular jurisdiction. Calculate the tax base and carrying amount for each item. The first one is dividend receivable On its balance sheet, Intiguan Sport reports dividend of 1 million receivable from a subsidiary. Assume that dividends are not taxable. Now, if dividends are not taxable, so it's something that comes beyond net income. So your carrying amount and tax base would be same because again there is no impact of taxes. Now this is the table given to us. As we can see, dividend receivable, carrying amount and tax base both are equal. Now, although the dividends received are economic benefit from the subsidiary, we are assuming that the dividends are not taxable. Therefore, the carrying amount equals to the tax base for dividend receivable. Part 2, development cost. Intiguan Sport capitalized development cost of 3 million during the year. Intiguan amortized 500,000 for this amount during the year. For tax purpose, amortization of 25%. Now carrying amount and tax base, the development cost is 3 million. So for carrying amount would be 3 million minus 500,000, and for tax base it would be 3 million into 1 minus 0.25. So 3 million minus 500,000 is 2.5 million. Because tax purpose amortization is 25% per year, so the remaining amount would be 1 minus 0.25. So 3 into 0.75 is 2.25 million. And this can be observed from here. The carrying amount is 2.5 and tax base is 2.25, and your temporary difference is of 250,000. This temporary difference, this is positive, carrying amount is more than tax base, so this would going to generate deferred tax liability. Third is research costs. Intiguan incurred 500,000 research costs which were expensed, so the research cost is 500,000, carrying amount and tax base, this is what we need to find out. It was expensed in current fiscal year for financial reporting purpose, so if it is expensed, your carrying amount would be 0. Assume the applicable tax legislation requires research costs to be expensed over a 4-year period. So 500,000 divided by 4 gives us 125,000. So the tax base would be 500,000 minus 125,000, that is $375,000. And we can see over here the tax base is 375, and over here the temporary difference is negative. So this will going to generate deferred tax asset, because we know the deferred tax liability, the formula is carrying amount minus tax base into tax rate. If there is a positive, carrying amount is more than your tax base for your assets, but we need to be very sure. This will going to give us a positive number, and hence deferred tax liability would be generated. Account receivable. Included on the income statement of Intiguan reports is a provision for doubtful debt of 125,000. The account receivable amount reflected on the balance sheet after taking the provision into account amounts to 1.5 million. So the carrying amount is given to us 1.5 million, and we have also a provision for doubtful debt. So your total account receivable would have been 1.5 million plus 125,000. So technically it should be 1.625 million. Because of provision of our doubtful account, 125,000 was deducted. So carrying amount would have been 1.625 minus 0.125, or 1.625 million minus 125,000. This would give us 1.5 million. For tax base, they say the tax authority allows deduction of 25% of the gross amount. So the gross amount technically was 1.625 million, and we can deduct 25%. This would be 1 minus 0.25. So 1.625 into 0.75 is 1.2187 multiplied by 1 million is 121,875. So this is your tax base. If you go back to the table, your tax base is 1,218,750, and your temporary difference is 281,250. This will again, this is $1,218,750. So we have the same number over here. And we also need to understand that the difference, temporary difference, is positive. It will again generate deferred tax liability, and we need to understand because all of these are associated with assets. If we are talking about asset, carrying amount is more than your tax base, DTL, deferred tax liability, would be generated. If this was a liability, if carrying amount of the liability is more than the tax base, then deferred tax liability is not generated, deferred tax asset is generated instead.